Welcome to Chapter 5. We're continuing with fundamental analysis, and this time we'll be taking a look at financial statements and ratio analysis. Now, we've got to believe in full disclosure. This is not as exciting as our previous chapter with the dividend discount models and the discounted cash flow models. Yeah, this is accounting. And let's read at the bottom of slide number 1. If an accountant's spouse cannot sleep at night, all he or she has to say is, "Dear, tell me about your day at work." Don't worry, we'll insult everybody by the end of the semester. Yes, this is more dry and more cut and dried and very simplistic calculation. So get out your 99-cent calculator. But important, very important, because this analysis that we're going to do rounds out our research, gives us a fuller picture. Okay? And the cool thing is, if you've taken accounting or you have a lot of accounting experience, the more accounting you have, the more you're going to understand as we peel back layer after layer of information about our potential investments. So let's get started on slide number 2, and that is the financial statements. Now, don't relax. Nobody's going to make you do trial balances and no journal entries. No. We simply download or go to our library, the financial statements. So we're going to take a look at the big 3. Balance sheet, which is what we own and how much we owe of that, how much we owe on those things that we own. That's more of a snapshot in time. And the income statement, which is more like the movie. It shows us what's coming in the doors, sales, revenues, and what's going out the doors in terms of expenses. And then this third one, which is the cash flow statement. And you may be thinking, especially if you've taken BUS123, financial planning and money management, well, how does that differ from the income statement? Well, we're going to see that because of certain financial procedures called generally accepted accounting procedures, the income and the cash flow may not always be the same. In fact, with large corporations, are usually never the same. The more we know and understand accounting, the better we will be able to understand and analyze the companies we are researching. And fortunately, we don't have to do any of the accounting. So let's take a look at the first one, the snapshot, the balance sheet. We list our assets, anything that a company owns that has value, and then our debts, liabilities. Liabilities and debts are used interchangeably. And that's the firm's financial obligations. What do we owe? What do we own? And what do we owe? And what is left over? In the financial planning and money management class, we called it net worth. But in accounting, they typically call it equity. And the reason it's called a balance sheet is because your assets must be equal to your liabilities and your equity. And the accountants of yore, before computers, of yesteryear, would make these huge spreadsheets. And they would put assets on one side, one series of sheets, and then liabilities and equity on the other side. Now, we humans, we tend to think of it this way: assets minus liabilities equal equity. Either way, it's fine. Now, we discussed time horizons from a financial standpoint. Short term, up to a year or so, maybe 2, maybe even 3 years, depending on the importance of the goal. Intermediate, 2, 3, up to 5 years, and long term, anything greater than 5, 7, 10, 20 years. But that's not how the accountants work. They lump everything into either current assets, which is our short-term time frame, 1 year, and anything greater than 1 year is long-term assets. So that's one little difference between the accountants and the financial world. So let's take a look at the balance sheet for Sprouts. You ever been to Sprouts Family Market or Sprouts Farmers Market? Sure you have. And, their major competitor is, what is it? The one that's owned by Amazon now. Whole Paycheck. I'm sorry, Whole Foods. But of course, they're also competing against all the major grocery stores. Yeah. So it's a very competitive industry that they're in. But here is the balance sheet as of the end of 2020. We can download balance sheets that are quarterly, which is probably a better thing for us to do at this time of the year, but we just like to see year-to-year changes. And so we go back a few years and we can see that actually they've done pretty well with their cash position, and there's a kind of a reason why. And these are all the accounting entries, and you would learn more and more and more about this as you took accounting. But they lump these assets into current assets, which are, within a year or so, basically a year. They say anything that's going to be consumed or utilized within a year, such as inventory. What's accounts receivable? That's money that's coming in the doors, and then other current assets. And then anything else is our long-term assets, long-term investments, plant, property, equipment, intangible assets. This is where it starts to get a little crazy. What are these intangible assets? Well, sometimes just a brand name is worth something, the accountants say. I guess it's true, because what would Coca-Cola sell their name for? And it's priceless for them. And then that's the total assets. So total current assets, total assets. And then we have our current liabilities, debts that must be paid within a year, accounts payable. So accounts receivable is money that is owed to us. Accounts payable is money that we owe. And then any short-term or current long-term debt that's coming due, and other current liabilities, whatever they happen to be. Rent, payroll, whatever. So they have the current liabilities, and then they have the long-term liabilities. And notice, one of the things that we notice if we peruse and investigate, is that a few years ago, by the way, everything is in thousands. So you have to add 3 zeros. Sprouts was, about $300 million in long-term debt. And what happened in 2019? You see what happened? They, for whatever reason, they decided, you know what? The interest rates are really, really low. We're going to borrow over $1 billion. And they've consumed some of that in the year, paid back some of that between 2019 and 2020. And so there's the total assets, total liabilities, and that gives us the stockholders' equity, what we like to think in terms of as net worth, and for us. So that's your balance sheet. And again, don't worry, you don't have to do any accounting. We just grab the numbers. Our trickiest thing is finding where the entry is, especially because you might not be at all exposed to a balance sheet. So just don't fret, don't worry, just peruse it, and you'll find all the entries that you are looking for. It's not that hard. Cool? Okay. Now our next financial statement is the income statement. It used to be called the profit and loss statement. I just call it the income statement. Because income is the difference between a company's revenues and expenses, used to pay dividends to the shareholders, or if they don't pay the earnings and dividends, they become what are called retained earnings and are held within the company to finance future growth or whatever. So the formula is very simple. You take your revenue minus your expenses, and that gives you net income. Well, the revenue is pretty straightforward. How much did we sell last year? Total revenue, total sales. Expenses get a little tricky because they break them down into several categories, as we'll see. And before we finish up here, let's take a look at the income statement for Sprouts. And we see that Sprouts' revenue has been doing pretty well of late. The revenue has been going up over the years, especially they did very well with COVID. A lot of stores were in deep kimchi, but not grocery stores because they were essential um, uh, businesses. So they've actually their earnings, their revenue. I'm sorry, this is called the top line number, and maybe some of you heard that discussed when you listened to the earnings call of the companies of your choice. This is the top line number, the revenue. The cost of revenue, or sometimes called the cost of goods sold, is how much we had to pay. Now, of course, Sprouts just buys milk and meat products and produce from somebody else. They're the grocer. So they had to pay for those things. And then you wind up with gross profit. Then you have to take away your operating expenses. And maybe some of you, when you were looking for SG&O or SG&A, here it is right there: selling, general, and administrative costs, payroll, rent, and other things. And so that gives us our total operating expenses. And here's where it starts to get a little tricky. We maybe have a little bit of income from or outflow from some other sources. And we get to our our earnings before interest and taxes, because now we got to pay our interest and we got to pay our taxes. And finally, we're down to the bottom line. And notice that these extra things, that extraordinary items and the like, we don't have to worry about with Sprouts. So our bottom line, our net income, our net profit is $287,450,000. So you see that Sprouts has been doing pretty darn well, hasn't it? Yes, it has, especially during the year of the pandemic, as many of their competitors had to shut down because they weren't essential businesses, where their bigger competitors like the grocery stores and the Whole Foods, and Trader Joe's. Trader Joe's is another competitor to Sprouts. So that's the bottom line. There's the top line, how much revenue came in the doors, and the bottom line is how much did you have left over. But it's a little more subtle than that. Some income and some expenses are not always received or paid for in cash. Huh? It's accounting, folks. Yeah, that's why there is the cash flow statement, sometimes called the statement of cash flows. Because there are some expenses that you really don't pay any dollars. You don't write a check out for. No cash leaves your checkbook. But still, you're able to reduce your income. And the biggest one is called depreciation. And if you've never heard of it or don't know accounting, don't worry about it. It just means we're going to take the value of an item and reduce it. And we get to write that off on our taxes, so we don't have to pay taxes on it. But we didn't write a check for that amount. So the statement of cash flows is trying to go back and see where the money went. See what happened to the actual cash position of the company. And there are various ways that cash position can change, from non-operating cash flows, investment cash flows, or financing cash flows, and income and expenses that are not realized in cash form. So again, we're not learning accounting, folks, but it's a little subtle, and the more you look at it, the more you'll say, oh, okay, I understand what's going on. Because notice that they start with net income here, and then start taking away, they add back in the depreciation, because they were able to reduce their income by depreciation, but they didn't actually write a check out for $225,780,000. So they add back in. And then they take some adjustments where they take some money out and put some money back in. And they made some capital expenditures that they took money out. And then they borrowed more money. So what happened, the bottom line in the cash flow statement in 2020, is that their cash went up by $82,505,000. Sorry, $82,505,000. Remember, got to put 3 zeros after each one. So that's, we dig deeper into the cash flow statement to see exactly, okay, what actually happened to their checkbook. And again, we're not making you accountants, so don't worry about it. Just peruse it, take a look at it, and remember you can go, all these links are into, most of them are Investopedia, but there are others, places that you can search these things for and become more acquainted with them. Okay? Okay, so now, where do we get our information? Slide number 6. Well, there is just an explosion of information now. I mean, I hear people just complain. I'm thinking, oh my goodness, these other, I'm used to my sources that I'm used to. I'm a big fan of the Value Line and other places. But there are so many more, and I don't even bother looking at them because I'm just like, this is enough on my plate. And that's the way other people feel too. They opine that nowadays there's simply too much information. I love this guy, Nick Murray. You probably will never read any of his books by him unless you get involved in the industry. But he has a great saying, wisdom sold separately, right? Sure, plenty of information. Here it all is, from the fire hose. But to make sense of it, yeah, it's not easy. Edgar is the repository, and I forget what it stands for. Look it up. I forget something. But all publicly traded companies must file an annual report. And what's that called? That's called the 10K. And this is where the face-to-face class, I just love to torture the students. The annual report is called the 10K. And then they have to file a quarterly report. And what is the quarterly report called? And then they go 10Q. And I say, what was that? They say 10Q. And I say, you're welcome. See what you're missing by not being in the face-to-face class? Anyway, because of technology, this is something that, as the internet was exploding in the 1990s, the Securities and Exchange Commission said, look, cool, let's create regulation fair disclosure, regulation FD, because now we have the technology to require companies to make public disclosures of material information all at the same time. What they can do now, and what they do, this is what they do, is you upload your materials, your financial statements and other materials, your 10Ks, your 10Qs, and the like. And then there's a few others, there's 8K and 8Q, and a few others. And there's a set earnings call, which is part of your assignment, right? For a certain time and date. And when that time and date happens, boom, the financial statements are available to everybody on the internet. And at the same time, the CEO, the CFO, and the COO get up and do a earnings call, a live earnings call. And you can call in or go online and watch it, listen to it. And some of you might have done that, or most of you probably just downloaded sometimes they keep the audio or video for around for a while, but usually they'll just leave a PDF. That makes it easy for you to review what they did. So that was part of your assignment. Now, those are the official sources. There are hundreds and hundreds, and who knows how many there are. I mean, anybody with a cell phone or laptop now becomes an expert. And they are looking for the whisper number. What's the whisper number? Well, we find out what the actual yearly or quarterly earnings are when the earnings call is initiated and the financial statements are available on the internet. But the whisper number is the number that's going around the internet, going around in unpurported and unofficial and unsubstantiated and all those other words that start with un. And that's what passes for investment research these days. What's the whisper number? Did they beat the whisper number? Oh no, they didn't beat the whisper number. The stock tanked. Did they beat the whisper number? Yes, they did beat the whisper number. The stock did really well, and that's short-term thinking for traders and speculators, and that's not what you're going to do, right? Should you pay attention? Well, take a look at what Investopedia says, and many other sources. But by the way, in my humble opinion, is no, don't play the whisper number game and sell the stock if it jumps 10% or whatever, and buy it. Or, well, if it's a stock you're really interested in and it doesn't beat the whisper number and all of a sudden it tanks 10-20%, there's a great opportunity, right? So you might play the whisper number in reverse, do opposite of what the speculators and traders are doing. Cool. Okay. Now, in this chapter, as we said, we're going to be looking at financial statements and financial ratios. And a financial ratio, we've already done a few, is the relation between two financial quantities expressed as the quotient of one divided by the other. And very simply, ratio analysis is the study of the relationships between financial statement accounts. Let's read together because this is very important. There is no one ratio that can accurately sum up the overall general state of a company. Each ratio must be considered in the context of all the information gathered, plus, you must consider any ratio in the context of the industry the company exists within. In other words, you have to look at their competitors. And we're going to see some examples in a bit. You can't just look at this one ratio. Ooh, this is the reason I'm going to buy the stock. Or, ooh, this is the reason I'm going to sell the stock. No, it's more like, I like to think of the music of the spheres. It's the music all around you, and you're hearing sounds from everywhere, and you're trying to create some kind of stew of information. I don't know if it makes any sense, but really, it allows us to round out. I use that term, and maybe that makes more sense. Round out the research that we're doing. Okay, so let's start with the common stock ratios, sometimes called the market ratios. And as I said, some of these we've already taken a look at. We've already looked at price to earnings ratio, dividends per share, dividend yield, the dividend payout ratio. We'll also add to these the PEG ratio, which is a cute little ratio, and a book value per share, price to book value, price to cash flow, price to sales. And these ratios use data from the balance sheet or the income statement or both. And many of these you just look up. You can just look them up. But some of them you have to do your own little calculations. And they're not hard. All you need is your 99-cent calculator and the financial statements. So the very first one, little bit of review, the price to earnings ratio. And a few students have already remarked about, well, what does it mean? Well, it depends, right? It depends on the situation. But we know it to be a very simple calculation. You take the market price, the sales price of the common stock, what the price per share is, and you divide it by the earnings per share. And it turns out that this is the most popular stock market statistic. Historically, PE ratios were in the 5 to 12, maybe 14, 15 range. 15 to 20 or so, that was left for growing companies, and greater than 20 was unusual. Today, it is commonplace. The PE ratio also tells you how long it'll take in years, assuming no changes in earnings, for the company to earn back its price. A PE of 3 takes 3 years, a PE of 20 takes 20 years, and I'll never forget. Of course, remember, don't put too much credence in that, because the price is changing, the earnings are changing, everything's moving in through time. But I will never forget when it was the internet bubble was raging, and eBay was selling with a PE of 10,000. 10,000. And I looked down at the Quotron machine, which you don't see those anymore. This was as we were transitioning. We still had the old Quotron machine, but we also had an internet connection. in it was like 1990, it was the late 1998, I think, or maybe 99. But I looked down and eBay's PE was 10,000. And I thought, okay, this isn't going to continue for much longer. And I'm thinking, so in other words, 10,000, at that, if nothing else changed, and of course things are changing all the time, but if nothing else changes, eBay would have earned back its price in 10,000 years. We were worried about the Y2K problem at the time. These people would be worried about the Y5K problem when it goes from 9999 to 10. Anyway, so what does the PE mean? Well, if it's high, 30, 50, 100, and some are these days, that means investors are very excited about the prospects for that company and are willing to bid up the price relative to the earnings. Now, are they right? We'll find out in 3-5 years, won't we? Right now, we don't know. If the PE is low, say 6 or 8 or 9, then investors are not too excited about the prospects of the company and aren't willing to bid up the price. But that's pretty much all we know, dear students. We don't know what's going to happen in the future. That's why they call it the future. So we can see from the PE what investors' expectations are, but it doesn't mean they're right, and it doesn't mean they're wrong. Some people say, don't worry about high PEs. It's a great company, buy it. But other people say, no, you don't understand. Value matters. You ignore value at your peril. So there's that eternal struggle. So slide number 10 shows us 6 different companies in 6 different industries and shows us very wildly different PE ratios. I mean, ExxonMobil, they're losing money currently. Don't worry, they'll start making money soon. It's from COVID. Amgen, so that's why it says NA, because if it's a negative earnings, it would be a negative PE, and they don't show that, they just show NA. Amgen, which is a biotech company, 21.67, not too high these days. General Mills, 15.16, respectable. Facebook, 25, which is on the low end of Facebook over the last 10 years or so. It's PE. And the bank, JP Morgan, banks are boring again, thankfully, 10. Investors are not too excited about the prospects for the banks, are they? And then Pfizer, a drug company. Normally, this would be considered high these days. That's actually pretty low. Well, what's the problem? We're not looking at competitors to one another. We need to make the picture more complete. If we take a look at Exxon, we have to look at their competitors. Now, BP, 10, basically. So not too excited. But you know what? People are more excited about the prospects for Shell and ConocoPhillips and Chevron. They're much more excited, aren't they? And that's why we put a little question mark here. We are being told by the investment community, it's a little red, I like to think of it like a little red flag that's being waved. Hey, there's something going on here. Investors are really excited about ConocoPhillips and Chevron versus Exxon, BP, and Shell. Why is that? Well, it means we need to do more research. It might be warranted. There might be a reason Chevron and Conoco are being priced at such a high rate. The same thing is true for the biotech companies here. You got Amgen, Biogen, AbbVie a little high, but all of a sudden Illumina, oh my goodness, why is Illumina so much more, why is their PE so much higher than the other 3? Well, again, we need to do research and find out, is it warranted? Are Illumina's prospects really that much more exciting than its competitors? We consult our sources, we do our own research, and we read everything we can, and maybe it turns out that, yeah, it does command that. Or maybe, I don't know, because you know what? If Illumina doesn't produce the parachutes had better be very large because there's a long way to go down till it hits 21, 23, 28, right? It's got to basically drop more than half the price before the PE ratio would be similar to its competitors. Here are the food companies, General Mills, Kellogg's, not too exciting. Okay, all right. Maybe Hormel, spam. If I ran Hormel, I would run a spam campaign because they're the people who actually make spam. And actually, the term spam email comes from Monty Python when there was a skit. Look it up, where all they were selling was spam, and the woman says, "Well, I don't want any spam." Well, that's what you're going to get. You're going to get spam if you go to that restaurant. Now, let's take a look at the internet companies. The truth is, these are very different companies, folks. They have very different business models. Well, Facebook and Google and Twitter, similar. But look at Amazon and Netflix. They've commanded high PEs for the last 10, 12 years since the Great Recession. And Twitter, oh my goodness. Why is Twitter, Twitter, why are they commanding such a high PE? Well, it means we need to do more research. And then the banks. Yippee! Banks are boring again. We love boring banks, at least I do, because they're reliable. There was a time when banks were very boring, and then all of a sudden, they got it. Well, not all of a sudden. It took about 20 years, in the 1980s and 90s, and finally they deregulated the banks and let them do whatever they wanted to do, pretty much with our money. And then they went, oops, we're sorry. We might take down the entire economy. And so we bailed them out. And as Mr. Ben Bernanke said, I held my nose and wrote the check. So banks are boring again. Hooray. Pfizer is a respectable. Merck, 33. Eli Lilly, 34. And then Bristol Myers, well, they're losing money. So no, not applicable. So you see, and this goes for all the ratios we're going to take a look at. We must look at their competitors. We must look at the industry, because if we don't, we're flying blind. We're saying, okay, well, this guy's got a great PE. Well, compare it to its competitors. Oh, maybe it's not that great. And that's true for all of the ratios we're going to look at over the next in this chapter. How can we account for the wide PE disparity between different industries and different companies within industries? Well, again, it's the expectation of future earnings, future dividend growth by investors. Now, if you're looking at this on a cell phone, you probably can't read what I'm about to read, but it's taken from A Random Walk Down Wall Street, one of the books you should read eventually. Hopefully you'll read One Up on Wall Street. One Up on Wall Street by Peter Lynch, and then A Random Walk by Wall Street by Professor Burton Malkiel. And then eventually, you're going to read The Intelligent Investor. I just know it. I know you will. So here's Jack Dreyfus, who was the founder of the Dreyfus Fund, which is Dreyfus Funds, which are now owned by the Bank of New York. Yeah. Take a nice little company that's been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's market, the early 1960s, mid 1960s, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth burners, which no one understands. A word that no one understands entitles you to double your entire score. Therefore, we have 6 times earnings for the shoelace company, 15 times earnings for the electronics and silicon, or a total of 21 times earnings. Multiply this by 2 for Firth burners, and we now have a score of 42 times earnings for the new company. Okay, and if you didn't understand the joke, he's saying that the more sexy and the more in the news the company is, the higher the PE, just because people are, get excited about it. And me some too. And of course, that was the technology of the day. Now you replace Firth burners with cryptocurrency or 3D printing, and you replace electronics and silicon with NFTs and meme stocks, and you can raise the PE to your heart's content until the company turns out to be all fluff, or what's the saying? All sizzle and no steak. Right, indeed. So now let's take a look at some of the other common stock ratios. The PEG ratio. You hear about it every once in a while. All the PEG ratio is doing is comparing the PE ratio with the growth rate. The idea was if a company was growing at 10% a year, it should get a PE of 10. If the company were growing at 20% a year, it should get a PE of 20. So when you compare the PE ratio with the 3 or 5 year growth rate, if they're equal to 1, that means they're growing at the same rate as their PE. So historically, a PE of greater than 1 was considered high. But typically now, it's much greater than 1. PEG ratios 3, 4, 5, and that's okay. Well, sure, we're willing to pay that until we're not. And that's why growth stocks tend to get hammered when all of a sudden the growth just isn't the same. So that's the PEG ratio, and you'll see it. Reported in some sources, and it's very easy to calculate. You take the PE ratio and divide it by the growth rate. The dividends per share. This is review, right? We already learned how to do this. You take the dividends paid to the stockholders and you divide it by the number of shares outstanding. But you really don't have to do it, folks. You just look it up. As we discussed, dividends became taboo during the 1990s. Since the 2000 to 2002 bear market, many investors have changed their minds about dividends. Dividends can be discussed in polite company again. And I love dividends. Dividends don't lie. The dividend yield. This is one of the other statistics we talked about in chapter 3, right? Introduction to stocks, and you looked it up in your assignment. It's the dividends per share divided by the market price per share. But again, we just look it up. This important statistic allows an investor to compare a company to other forms of investments that pay income such as savings accounts or bonds. Traditionally, 4, 5, 6% was considered good. That was often more than what bonds were paying because stocks were considered far riskier. Currently, this is October 1st, but September 2021, the S&P 500 is yielding 1.28%, while the 10-year Treasury bonds are yielding approximately 1.3%. Actually, now they've jumped a little bit. The 10-year Treasury has gone up to close to 1.5%. But many savings accounts are still yielding less than 1%, right? Some stocks are paying much more than 1.28%, 1.5%. Some stocks are paying 3, 4, 5%. They're out there. While many growth stocks pay no dividends, why? They need to reinvest the earnings, retained earnings, back into the company to fuel their growth. That's the dynamic. The dividend payout ratio was something we also looked at in chapter 3. You take the dividends per share and divide it by the earnings per share. It's a measure of how much of a company's earnings are being paid out to shareholders in the form of dividends. More mature companies often pay out almost all their earnings in the form of dividends, whereas growing companies need those earnings, those retained earnings, to support the growth of the company. So a very mature company might pay out 50, 60, 70% of their earnings. We're going to take a look at real estate investment trusts at the end of the semester, but they look like stocks, and they are required, because they're not a stock. They look like stocks. They're actually a trust, and that's a whole different world. But to us investors, they look like a stock, and they have to pay out at least 90%, or is it 95? I think no, it's 90%. They have to pay out at least 90% of their dividends. That's part of being a trust. So check that out. But we just look it up. We just go online and we look up what they're paying in the form of absolute dividends, and right next to it, they'll show us the dividend payout. Well, they won't show us the dividend payout ratio. We normally have to calculate that, taking the dividends per share and dividing by the earnings per share. They will show us the dividend yield, which is the previous slide. My apologies. Now, book value per share. We talked about this a little bit, right? It's a measure of the net worth of a company on a per share basis. we can do the calculation, but again, we just look it up. Common stockholders' equity divided by the number of shares outstanding. The book value per share tells an investor how much assets are behind each share of stock. In other words, if all the assets of the company were liquidated, how much would each shareholder receive? It is common for the actual market price of a share to be above the book value per share, sometimes far above, since a company is worth more intact than if it were dissolved, right? How much is a shoe store worth, or a pizza shop? The fixtures, maybe the pizza oven's worth a lot of money, but the company is worth more intact, earning money, than if you sold off all the assets, paid off the debts, and walked away. And as we said, it's far, far above the market price, excuse me. I'm sorry, the book value. The market price is far above the book value for many companies that you look at. Take a look. Check some. In Yahoo, you go to statistics, and then scroll down on the left side. You'll see the book value per share. And remember that accounting is a little funky. Remember that they depreciated a lot of these assets, so the book value is saying they're worth $100 when they might actually be worth a lot more, or they might actually be worth nothing. And all we know is what it's worth on the books. And that may or may not have anything to do with the real world. That's why in the financial planning and money management class, we use fair market value. In other words, what a reasonable person looking for something of the like would actually pay for that. But not the accountants. No, they use their generally accepted accounting principles, and they may or may not be worth what somebody would buy them for. Price to book value per share. Well, it's the same idea. Remember price to earnings? Well, in this case, we're taking a look at the price to book value. You take the market price and divide it by the book value. Given that the book value per share is often less than the market price, the price to book value per share tells an investor how far above the book value the market value is. And if that doesn't make any sense, read it again because it's pretty straightforward. If the price to book value per share is equal to 1, they are the same, but that's not going to happen except in really, really bad situations where the company is in danger of folding. Today, the price to book value per share of 3 or 6 are not uncommon. Now, in the Great Recession, in the global financial crisis, the market as a whole, the price to book value per share went down below 2. I forget where it hit, but it was about 1.7 something, 1.8. And that was a phenomenal time to buy. It was a phenomenal time to buy. Now, what happens if the market price goes below the book value per share? Well, that usually signifies a very sick company. And there's a danger of the company folding, literally folding, because its market price has fallen so far that the corporate raiders start to take notice. And they decide, there are some assets here that we can take advantage of. So they swoop in, buy 50% plus one of the shares, which means now they run the company. And they sell off all the assets, pay off the debts, and walk away. Maybe, maybe not, with money in their pocket, extra money in their pocket. And that's capitalism, folks. We might weep and gnash our teeth and say, that's horrible. What do you did to those people who are employed by that company? And the economists and the corporate raiders, if they deigned to speak to you, would say, you don't understand. That capital in that company, including the human capital, the people working there, was being allocated inefficiently. We are simply just breaking that we're like a farmer plowing over the field. We're breaking loose that capital. And it might sound all well and good, but I got to feed my kids, right? I just lost my job. And that's why we have unemployment insurance, because we want people to find employment that is more efficiently allocated toward the good of society. Sounds like an advertisement or like a speech at some Anyway, let's continue. Slide number 18. Same idea. Price to earnings, price to book value, price to cash flow. Current price divided by the current cash flow per share. Cash flow often differs from earnings per share for several reasons, but as we said, the most common reason is depreciation, which is not an actual cash expenditure. We didn't write a check to depreciation, so that money stayed in the company. But there are other reasons that cash flows and earnings differ. And you will hear analysts and other investors talk about good quality earnings versus poor quality earnings. And the formula is exactly the same, except instead of market price divided by earnings, it's market price divided by cash flow per share. And let's take an example of this. During the internet mania, many companies were reporting record earnings. Wow, look at those earnings. But if you looked at their cash flow statement, you see that their checkbook balance is going down. Now, how could that be? That doesn't make any sense. How could people be making record earnings and yet the money's going away? There's not as much money coming in. Well, it's actually very easy. And one of the premier examples of this was Lucent Technologies. Now, you probably never heard of them, but AT&T, before it was broken up in the 1980s, had an engineering arm called Bell Labs. They're the people who developed the transistor and the photovoltaic solar panels, right? They developed a bunch of other stuff too. Unix, that's where Unix comes from, Linux, which eventually became Linux. And they also had a manufacturing arm called Western Electric. They were the people who make the telephones that last for 100 years. We still have one. And if we still had a landline, it still works, but we don't have a landline anymore. So they become collector's items, and you put them on the table, and the young kids look at them and they think, "What is that? It looks like a telephone, but what is that round thing on there?" Anyway, AT&T got broken up, and they divested themselves of Western Electric and Bell Labs, and they became Lucent Technologies. And Lucent Technologies was building the best telephone equipment in the world in the 1980s and 1990s. And of course, at this time, there was a tremendous push for internet connectivity and telephone, wireless telephones or cell phones, mobile phones. And so Lucent Technologies was very popular. And all these new startup companies were saying, "Oh, will you sell us $2 billion worth of equipment? We don't have any cash and nobody will lend us any money. So would you lend us the money to buy your equipment?" And Lucent said, "Sure." It doesn't cost them that much to create their equipment. So they became the bank. You see where that might not work out so well? It didn't work out so well. These companies, many of them never earned a dime, and they eventually folded and went bankrupt. And so what happens? Lucent Technologies gets the equipment back, but hey, now it's obsolete and they can't sell it. They don't want it back. They want their cash, but they're not going to get their cash. And Lucent Technologies almost went bankrupt, almost disappeared, but didn't disappear. And then eventually they merged with another phone company, and I forget what they're called now, Lucent Alcatel or something like that. So check them out. And the story of how your record earnings could be broadcast to the world, and at the behind the scenes, if you had looked at the statement of cash flows, the cash flow statement, you would realize something's not right here. And that's why we do our best to understand the accounting, but the accountants, the more accounting we learn, however, because we have some awesome dynamite professors at Southwestern who teach accounting, so check them out. The more we understand what's going on under the surface. And then last, before we take a little break, is the price to sales ratio. Same idea, price to earnings, price to cash flow, price to sales. Instead of using earnings or cash flow, because a lot of these companies never made any money, we'll use the sales. We'll take the price to sales. And of course, a higher one meant things were going well, supposedly, but if they haven't making any earnings, that's not a good sign. And during the internet mania, again, many analysts use price to sales instead of price to earnings or price to cash flow, since many of these new high-flying technology companies never generated any earnings and most of them all disappeared. So, what do you think, right? Most of these common stock ratios we just look up and we maybe calculate a few. But when we come back, we want you to get out the balance sheet and the income statement, and you can get the cash flow statement too. But the balance sheet and the income statement, and you're probably going to want to get out but you don't need it, but you want to get out the formula sheet for this chapter, because that has all the ratios on one page and tells you which statements to use. Okay, because we're going to come back, bring your 99-cent calculator, and we'll do some of these calculations. We'll do the profitability ratios, we'll do the liquidity ratios, the activity ratios, and the leverage ratios. Exciting stuff, huh? Oh, come on, humor me. Thank you so much, dear students, for being in our class. We are so proud of you. We believe you are awesome, and we're very, very proud of you. See ya.